Warren Buffett believes that earnings growth is overrated, and he's even said it's an improper figure on which to focus. But why? Aren't all CEOs trying to grow their company's earnings? Well, Buffett explained his reasoning in his now famous 1979 letter to shareholders. In this video, I'll break down why Buffett believes that earnings growth is overrated and what metric he looks at to judge a CEO's performance instead. Hi, my name is Brian Feroldi. I'm a financial educator who's been analyzing and investing in businesses for more than 20 years. Now, in 1979, Warren Buffett successfully grew Berkshire's earnings by more than $3 million, or nearly 9%. But he quickly downplayed this achievement. Now, Buffett noted that he had substantially more capital to work with in 1979 than in 1978. And he even took a dig at himself, saying that our performance in utilizing that capital fell short of the earlier year, even though per-share earnings rose. This is why Buffett wasn't impressed with his own performance in growing earnings. He knew that he had more capital to work with in 1979, so he would expect that his earnings per share would grow due to that fact alone. Buffett then went so far as to say that earnings per share would rise even in a dormant savings account, simply because earnings are continuously plowed back and added to the capital base. This is why Buffett says that earnings and earnings per share are so overrated, simply because they ignore the underlying capital base that the management teams are working with. So if Buffett doesn't think that looking at earnings growth is the best way to judge his performance, what is? He later said that the primary test of managerial economic performance is the achievement of high earnings rate of equity capital employed and not the achievement of consistent gains in earnings per share. Well, that begs the question, what does return on capital employed even mean? Well, to understand that, let's first think of how a regular savings account works. Money gets put into the account from a person's savings at a bank, and then the bank pays that same account holder in the form of interest. So for example, if you put $1,000 into a savings account and the bank was paying 5% interest, you would earn $50 in interest payments per year. If we wanted the interest rate on that savings account to increase, what could we do? Well, one extremely simple answer is to put more money into the savings account. If we increase the amount of money we put into the savings account, say doubling it to $2,000, and that interest rate of 5% stays the same, we would double the interest that we were getting paid every year. In this case, it would go up to $100. Now, there's nothing magic going on here. When you put more money into a savings account, you naturally expect more interest will be paid to you. Well, believe it or not, but this exact same simple logic also applies to businesses. In fact, it can be helpful to think of a business the same way that you think of a bank account. Money goes into the business from investors in the form of equity and from lenders in the form of debt. The company then puts that money to work to generate more money. Now, there are lots of ways to measure how much money is coming out of a business, such as net income, which is also called earnings, and earnings per share. Now that we know this, here's a question for you. If we wanted to increase the earnings per share of a company, how would we do that? Well, one simple way is to put more capital into the business. If the company generated the exact same return on the money that was put in, you would naturally expect more earnings to come out. This is exactly why Buffett wasn't impressed with his 1979 performance. More capital was put into Berkshire Hathaway, so naturally he would expect that more earnings would come out of Berkshire Hathaway. This is why he believes that focusing on earnings and earnings per share alone is so overrated. It ignores how much capital went into the business in the first place to generate that earnings. So instead of looking at earnings in isolation, what matters to Buffett is the ratio between how much money went into the business to how much money comes out of the business. If you can measure those two things, it will tell you the interest rate that the business is generating on the capital that goes into it. So how do we figure out what the interest rate is that a company is earning on the capital? Well, this is what return on capital ratios measure. They tell you the interest rate that a company is earning by comparing how much capital goes into a business to how much capital comes out of a business. Now, there are many return on capital formulas, but they all follow this basic structure. In the numerator is what the business earns on an annual basis, and in the denominator is how much capital was invested in the business. Now, how do we measure what a company earns on an annual basis? This is how much profit comes out of the business, and there are numerous ways to measure profit. We already talked about net income and earnings per share, but you can also use metrics like net operating profit after tax, or NOPAT, as well as EBIT, or earnings before interest and taxes. Now, where do we go to find these metrics? Well, the answer is almost always on the income statement. So that's why when measuring returns on capital, the numerator is always a profit metric from the income statement. Now, how do we figure out how much money was invested in the business? Well, the way that we can tell how much money went into a business is by looking at the amount of equity that investors put in and the amount of debt that lenders put in. Now, where can we find these numbers? Well, debt and equity is always listed on a company's balance sheet. The debt is always found in the liabilities section, and the equity is always found in the shareholders' equity section. Now, there are lots of formulas for measuring the return on capital that a business generates depending on what you put in the numerator and the denominator, but Buffett tends to focus on three primary calculations. So, a metric that he looks at, number one, is called return on equity. The formula here is very simple. It is net income in the numerator and average total equity in the denominator. So when we think about this equation visually, in the numerator is the amount of net income that a business generated as found on the income statement, and in the denominator is how much equity was put into the business, which we can find by looking at the shareholders' equity portion of the balance sheet. Now, return on capital metric number two is something called return on capital employed, or ROCE. The formula for this has earnings before interest and taxes in the numerator and assets minus current liabilities in the denominator. So when thinking about this calculation visually, we take the company's operating income in the numerator, or earnings before interest and taxes, and then we divide by the company's assets minus its current liabilities. The difference between those two will tell you how much capital has been employed in the business. The final return on capital metric to look at is something called return on invested capital, or ROIC. So when thinking about these numbers visually, we take the company's operating income, or net operating profit, and then we subtract out the tax expense that the company has. And then we divide that by the company's assets minus its accounts payables and accrued expenses and any excess cash that the company carries. Now, there's no need to calculate any of these return ratios yourself. We can use software like FinChat to do this automatically. So in FinChat, you simply click on Financials, and then Ratios, and then scroll down to Capital Efficiency. When we open this up, we can see that we have return on invested capital, return on equity, and return on capital employed right here. If we click on return on invested capital, we can actually see it being graphed over time. Now, great, we know the math behind these calculations, but how do we interpret the results? Well, the truth is that the results can vary greatly depending on the industry that the company is, but there are some general guidelines that I think are helpful to think of. When looking at the results of any of these calculations, I consider a low number to be anything less than 10%. I consider an average number to be between 10% and 15%, and I consider a high number to be anything that's consistently over 15%. If you can find a company that consistently generates returns on capital over 15%, that's kind of like finding a savings account that pays a 15% interest rate. Now that we know what these numbers mean, let's compare and contrast a few different companies using FinChat so we can tell how much a return they're getting on their invested capital. To start with, let's pull up a simple company like Chipotle, which is ticker symbol CMG. Using FinChat, I had this calculate Chipotle's return on invested capital over the last decade. We can see that in 2015, the company generated returns on capital of 26%. That number dipped in 2016 to just 2%, but it's been climbing back ever since. It did dip again in 2020 due to the pandemic, but it's been rising for a couple years and recently clocked in at about 19%. So Chipotle is currently earning a 19% return on the capital that's been invested in the business. Now let's compare that to a company like Boeing, which has been struggling recently. Back in 2015, the company was earning returns on capital that were just shy of 10%, reaching a climax of about 13% in 2018. After that, the company ran into a series of issues that has caused its return on capital to struggle mightily. More recently, the company has even struggled to earn a positive return on capital. Knowing this, it's not surprising to me at all that Chipotle stock has been soaring over the last decade and Boeing stock has been struggling. Now, if you're like me, you might be thinking, why don't I just buy the highest return on investment companies that I could find? Well, that's certainly a good starting point, but just remember that Buffett called this the primary test of managerial performance, not the only test. Moreover, there's more to finding a good investment than just finding a company that generates high return on invested capital. In fact, if you look at Warren Buffett's own investing checklist, it's obvious that having high returns on capital is very important, but it's only a tiny piece of the overall pie that he uses to make investment decisions. Now, speaking of Buffett's investing checklist, if you want a free PDF copy of that graphic I just showed you on the screen, simply visit longtermmindset.co/Buffett checklist or click the link in the video description and I'll email you a free copy. Well, thanks so much for watching this video. I hope it helped to clear up why Buffett thinks so highly of returns on capital and not just earnings per share. If you enjoyed it, the thumbs up really helps us out on YouTube, and let me know in the comment section below what other topics you'd like me to tackle. Now, if you want to continue learning from here, I highly recommend that you watch this video next.